The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Good morning and welcome to Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group. Here with me today is Alex Monk, also from Akers Financial Group, and he's also a certified financial planner practitioner. And we've been working together more than 10 years. Good morning, Alex.
Morning, Brian.
How are you doing today?
Oh, I'm good, man. This is my wheelhouse.
This is your wheelhouse? Happy New Year?
Oh, yeah.
Or the radio show your wheelhouse?
Yeah, both. I mean, 2023 is definitely a great year for me so far.
Yeah, absolutely.
You know, but it's early on, so we'll take it in stride.
Absolutely. So the show, Winning in Retirement, we welcome you and thank you for listening to the show. And we're going to give you information that you can use right away. So make sure you pay attention as we go through things today. Now, when you think about what's going on, what are the top investment trends? It's not really the best investment advice, top trends, best investment advice. Typically, people do want to choose the hottest investment. When investment fundamentals will actually get you to your retirement dreams. This show is about applying all that's out there about investments to your individual situation. So we're calling this show 5 Investment Fundamentals. I had to think a second about, was it 5 investment fundamentals or 10, 12?
Well, so you said there's like 2 things like in fundamentals, right? So that's like your basic stuff, right?
Yeah.
That's like, your staples, whatever it is. But then you also said, what's the hottest trend in investing?
Well, that's what people are looking for right now, and that's probably one of the hottest things on the search engines out there is investment topics. And so you search that, and then when you search on that, you find a lot of different topics, and most of them are all about what should be the hottest investments, make the most money, the highest risk. It seems that what people are trending and looking for.
Right, or who paid the most for advertising?
Could be. Yeah. Well, that's when it comes to not individual stocks, but more to products that might pop up like that.
Right. And so every year there's always a new trend. A couple of years ago during the pandemic, it was SPACs, special acquisition corporations, and that was the big news. And now it's, a lot of people are talking about custom indexing or indexed investing, all these different gimmicks, games, different ways to package something that doesn't need to be reinvented.
Well, that's a big show. We probably can't cover all that, but not being invented or not. But I think what we want to do is think about that person's mindset, and the mindset of they're searching the internet, trying to find where to put their money to make money as fast as possible is probably the approach that many people that search are looking for.
Yeah. So what does that tell you about that person?
It says to me that they need to listen to our show and understand that if they have the basic investment fundamentals down, they're going to achieve each and every goal in their life. Why take an approach that has a chance of working out when we can teach you the secrets or the things that you need to know that are going to really help you reach your goal, because you're going to take advantage of everything you're doing and making sure you're doing it well and according to your personal goals. I think the planning and the wealth building is easily to do when you think about the fundamentals of how to do it.
All right. I like that. That sounds good. Where do we start?
All right. So let's just examine the word fundamental.
Fun is all I hear.
So you hear fun, but I think what I get out of it is you got to use your brain on these things. Fun, and it's mental. Okay? If you want to have fun with your money or investing, it's mental. Mental means you got to use your brain when it comes to actually investing your money, not your heart.
Ooh.
So imagine brain versus heart on investments. Your heart's going to chase things. It's going to hear the fancy things. Oh, you made 50% on that? Oh, I want in. As if it's going to go up 50% again. Right. Many times if something has a pop, what you're going to experience is that person made the money. You're the one they're selling it to. They lock in their profit. You get to ride the roller coaster back down.
And it's always the number one fund or whatever it is the year before that gets like the headline risks, and that's where the money starts to flow, and it's too late.
Yeah, there was these magazines, like, back in the day when they had paper magazines, they'd come out with the top picks for the last quarter, and then people would put their money in that, and then they'd lose. And they go, well, why? Well, it already went up. That's why it was a top pick. It's almost like if you're a contrarian is someone that's negative all the time. They'd say, hey, who's the worst one last month? Let me buy that. And that's not a bad approach as long as you look at the investment, use your brain, and find out if that investment is viable and has an upside again and will come back.
Right. So there's a lot of investments out there that have had some downside here in the recent, year or so. But do they have that upside potential? And that's what you have to ask yourself. Like, all right, where is all my money? Let's start using our brain and looking at this stuff.
I like to call since November of 21 to now a tech bubble that got burst. That tech is small tech. It's the tech that has been trying to reach for the stars, all the new technology. It's a lot like the late 90s, where in the late 90s, there was lots of companies that came in, the stocks went up and down, disappeared, and there's a few winners at the end. And that's exactly what's sort of working itself out when you look at all the different EV stocks, the automation, stocks, technology, internet technology, robotics, all kinds of things. There's companies that are going to be very successful, but not all of them are going to be winners. So you really got to become more of a stock picker when it comes to building that high risk portion of a portfolio.
Absolutely. And you bring up like the old things that happen in tech, and it's such like a new industry. Like these companies form, they're all trying to be that number one, and not everyone can be that. So you see these natural cycles. Like people think, the market's never going to come back. No, well, this is a healthy thing. Mm-hmm. Like this needs to happen. Like the tech market just can't go straight up. I mean, everyone agrees there's going to be more technology in the future, right? I mean, that's not a thing that's for debate. It's just these markets need these cycles.
All right, so let's start with that. We talked about fundamental. Let's talk about this. The 5 investment fundamentals we're going to cover in the show. The number one is this. Why are you investing? You need to know why you are investing your money. That dictates a lot of things. What are some of the things that it actually helps with?
I mean, that's the number one thing in investing, Brian. So you have to know why, because you're going to need time horizons. You're going to need, when do I need this money?
Right.
When do I not need it?
What risk level you want to take with it based on the time.
Yeah, so how much of this money can I afford to lose? Or how long can I wait for this money to recover?
Right.
Like, what's the goal? Because that really not only tells you how to invest it, but it also gives you the perspective of how did you do?
Right. So I was meeting with a client over the last 2 weeks, and that client and I they are the husband and wife. The wife wanted to retire basically in 1 month. This is the second time I met with them. And we finally got all the information there. I'm looking at it, and I said, overall, it looks like you have enough money, but we got to find the way for you to retire. Like, how can you retire? And then, like, the husband was very conservative about the approach of retirement, a little nervous about actually retiring. We talked about that for like an hour about how to have the cash flow, the right budget, the right amount of money to meet the needs, and how to say in your mind, yes, we're good, let's retire, how to get to that point in your numbers. Then he pulls out a 401k statement and says, and this is what I just did with my investments. So the first hour was about conservative, how do you retire and have money last a lifetime. And then he comes out and gives this and says, I reallocated my 401k. I put all of my cash into global and international stocks. And so his 401k, let's call it $1 million, 30% was allocated in December into global and international stocks. Now, is that a conservative, getting ready to retire next month type of portfolio?
That's like yin and yang. You had one conversation, and then the second one's just completely different.
Right. And so basically I had to call it out, and I had to say, well, you're telling me this is your goal in life. This is your why you want to invest your money. And then the investments are this. And I asked him why. He goes, well, my approach has been through my career is watch the market, and I trade my 401k plan based on what's going on in the market. And I take the risks that are there to grow it. And I said, and that's why you have more money than you actually need mathematically, because you were very successful doing that. But now we got to take some of the winnings off the table. We got to build a portfolio that's retirement ready, one that's going to have a support of money to produce income that you can guaranteed count on, reliable inflation, that we can take care of that throughout their lifetime, so that he can say, yes, she can retire next month and I can retire next year, and we're going to be okay.
And limit those big losses. Like, it sounds like, everyone's worried because they have to switch and they're starting to get their paycheck from themselves.
Right.
Like, that's a big thing logistically, mentally. It's a lot to get over. But then to pile on the risk at the end, it's like, whoa.
Right. So this fundamental idea of know why you're investing, when you are younger and want to build and grow, and you see your 401k statement, and you say, "Oh, I put in $5,000 and my account's down 10. I can't keep doing that." Well, guess what? You should, right?
That's the time to do it.
Why is it the time?
Because things are cheaper.
And that's fundamental investment number 2.
Ooh.
Buy low. If you look at your portfolio, the idea that I mentioned in my example, that person who just come in to meet with us, that idea of buying international, the buying in growth stocks, buying tech stocks, things that are low, could be the right time to buy if they're low in a long-term portfolio that's designed for growth with risk. You got to look at your reason why. And then the second thing is consider buying low. Sometimes we don't buy low, we buy often. We buy dollar cost averaging, right?
Yeah, and that does what we were talking about in the first part, right? We take the heart out of it, the emotions. Because you can turn on the news any day and have a panic attack. I mean, you can Google yourself into a frenzy, no problem. And that's not going away.
Google yourself into a frenzy. That should be the name of the show, right? No.
And you can do that. Like, there's always going to be some type of news. There's always going to be a reason not to invest. But we need to look at reasons why to invest when retirement is going to happen no matter what the market does.
Yeah, so Akers Financial Group, we are financial planning advisors. Investment management is what we do with our clients to implement what we recommend in the planning side. Because what you design and plan for, you then got to make it happen in your portfolios, in your accounts that you have at work, in the way you manage all of your money. It has to tie in to what your plan is. It seems like a simple approach, but it's not. At Akers Financial Group, we sit down with you and talk about what's going on in your situation. Akers Financial Group, we're local, independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville and Forest Hill, and we meet with clients all around the state, Mid-Atlantic region, around the country. It's so easy to begin winning in retirement. All you got to do is to call us to get a free consultation with one of our team of advisors. Give us a call at 833-WIN-RETIRE. That's 833-WINRETIRE. We will call you on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Why do you invest? The answer to that is really important. We'll discuss more of that in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome to the second quarter of Winning in Retirement. I'm Brian Akers from Akers Financial Group, and here with me today is Alex Monk. We're both certified financial planner practitioners from Akers Financial Group, and we welcome you to Winning in Retirement, where today we're talking about 5 investment fundamentals. And the reason is that sometimes when you start out a year, what you want to do is, let's find the hottest thing to invest in. When the basic thing is this: hey, let's get back to basics. Let's have some fun. Dumb mental. Because it is about using your brain. Because you got to use your brain when it comes to your money. Because you want this money to last a lifetime, and we know it has to last a lifetime. And that's why this quarter we're talking more about why do you invest. The answer to that question is extremely important in reaching your goals in the future. So, what's your thoughts on just the basic concept of why people invest?
And I ask people that all the time when I meet them. Yeah. I'm like, okay, so what's the goal here?
I've heard you say that in that emotionally way you said it.
I'm just looking at them with this dumbfounded look, and then they look back at me and they're just like, what do you mean? Like, I don't know. I'm just saving to save.
Yeah.
And as they get closer to retirement, you see people's eyes kind of open up when it's, okay, well, we have to live on this money. Yeah. Like, this is everything.
It's like get serious time. All of a sudden, they want to look at it. They want to put it all together. They're at a point where, all right, I need to count on this money. I better start looking at it.
Right.
Now, some people that are incredibly successful for us have been clients a long, long time, and they were serious early with the small amounts, and now that money's had the amazing compounding over time, it's incredible.
Right, and it's not a, why are you investing? It's not a, let's Google the best investment for this year and we're going to get rich quick.
Right.
It's almost like it's a lifestyle. It's we need to dedicate different parts of our money to do different things in our lives so that we can do all the fun stuff.
And that's exactly what we're trying to do here, covering 5 investment fundamentals. He's talking about our third one. Our third one is this: a reasonable risk based on your goals. Take reasonable risk based on your goals. Reasonable risk. What does that
mean? Let's say I have, just for easy math, right, $100.
Nice.
Okay, but I need 200 to live on.
Okay, and that's for today or just the whole week?
Yeah, just because my math is tough for me.
Okay.
Do I put all that money on red and hope I double it?
Yes, that's gambling.
Right? Or do I put some of it at risk? Do I put some of it to be there? Like, what's my answer? So a lot of people, their answer typically is, if they haven't saved enough money, is let's add on the risk. And that is actually probably the exact opposite of what you should be doing. Because if you don't have the money to lose, you don't want to take high risk bets.
Right. And the thing there is you don't have the money to lose. So let's imagine someone's younger. Now, if we know the why we're investing that money, we need to take the risk, even if it is a small amount.
Absolutely.
Now, in fundamental planning, what we would tell you to do is, hey, let's get some of those credit cards paid off, because if you haven't noticed your credit card statements, they raise the interest rates on them faster than you can blink. What was 19 might be 28 now. But it's a fun gift for this year in case you want to look at your credit card statement.
Big numbers.
So you pay off a credit card debt and you cut out the 28% interest. You just earn and saved yourself 28%. Sounds like a good deal.
That's a winning bet, right? Because
Right.
it's a guaranteed thing that credit card, they're going to charge you interest.
That's very true. Credit cards are going to make their money. They're highly profitable, just like banks were highly profitable when interest rates were low.
Right. And then debtors were in favor, right? When interest rates are low, if you have debt, you win.
Yeah, but what happened was the savers got burnt.
Right.
And so the idea of reasonable rates of return has changed actually over the last 3 to 4 months, in that if you have money in the bank, if you look out there and check things out on the fixed side, you could actually make money on your money.
I know. And there's so if you're with a big bank that may have like a 3-letter abbreviation in its title,
sure,
you might be getting 0.05 on your money market. But there's other places that'll pay you 3 all day long.
And the hardest part is for you to have a reasonable rate of return. Now, if we make 3%, we're still not beating inflation this year because inflation's so high. And that's why we have to have a mix of investments. A reasonable rate of return means that we have to take some risk with our money. If we don't ever take risk, we're never going to keep up with inflation. Inflation is truly a real rate of return on your money is what we got to achieve when we invest.
So this kind of ties me back to what you said earlier, the purpose.
Yeah.
So it's all tied together, right? You can't take all your risk with all your money.
No, so if you put your goals into little buckets and you say, okay, well, this bucket is my retirement plan at work. Retirement plan at work could be 30 years for you, could be 5 years for you, anywhere in between, or you might be looking at retirement in the back rearview mirror. Sorry, wrong comment.
It could have already happened.
Absolutely, yes. And so when you think about that amount of time you have, and you look at the portfolio, should you just go ahead and click that target date fund? Is that going to be the only way to do things in life?
Well, that's the way they're going to opt you in. So if you started when you were 20 or however old you are, you might have this aggressive target date fund, which means what? That you and everybody else that retires that year should be invested the same?
That's exactly right. That's what target dates funds do. They were designed to take the risk off the employer and off the trustees and to spread your risk out. And that spreading of the risk out has almost led to over-diversification and, in my opinion, some worsification. Worsification is where it's not designed for you. And one of the things that you want to think about doing is think about your goals with that retirement money and your risk tolerance and what is your reasonable rate of return and what is your expectation.
And I think that last thing you said, expectation's huge. Because what these target date funds did was they didn't have, I would say that their amount of risk was more than what people thought.
For those getting ready to retire,
right?
But for those younger, they have some of the money in money markets, maybe 5, 10, 15%, making zero in the money market over the last 5 years. And that was their allocation. Put your money there.
And that's not right for the young person, but then the retired person, it's on the flip side. Mm-hmm. So they're taking too much risk with their quote unquote safe money.
Correct.
Because we're in a rising interest rate environment. I don't know if anyone's missed that. It's kind of, we've been talking about it for a long time.
Yeah. So like when you think about rising interest environment for 2022, that led to the bond category on bond funds to lose 13% as a broad index for the year 2022. So when a target date fund moves you to lower risk, that down 13 is not lower risk.
No matter how you do the math there. Yeah. If your safe money lost 13, your money's not safe.
And if you've heard our show for years, we've been telling and talking about this topic because we talked about it before it happened. Now we're talking about it after it already started. We don't believe that over the next 10 years that rates are going to stay where they are today. In the short run, we can easily see it go up a little bit higher, and then start to drift back down, and then head back up in a few more years. There's a lot of ifs to the future, but if you own bond funds, you got to question, is that truly the best investment when interest rates were already at their high like 40 years ago? They've been coming down for 4 decades, and now it's time for them to start to drift up over the next decade or two.
Right. And so if that's your answer for safe money, then you took way too much risk and you did not achieve your goals.
So reasonable risk is where is your money, and understanding, well, reasonable risk, are you taking what's reasonable for you and what fits for you?
Exactly. So ask yourself this. If I'm in a bond fund and I lost, let's call it 13% this year.
Yep.
Will my investment go up 13% next year?
Not staying in that same fund.
So that is a bad risk reward like a give take, right?
Yep. Because whenever you have a big loss, you then have to get back. Now, if you were in stocks and you had a big loss, so like the S&P was down like 19.4 in 22, and you went down 19% like that, you're going to have to make like 31, 32% just to get back to where you're even again.
Right.
And that might take a couple years here on the S&P 500 over time. A couple years is couple. That means that
you have the ability to do it.
Yes. The bond funds are going to make money through interest, whatever interest they're paying, but how are they going to make 13% is going to take them maybe 5 years.
Just to get back.
Right.
So that's a bad risk reward.
Now, for those that are in them, you might say, hey, there might be a brighter day in the next 6 months as if interest rates went back down again, because the Treasury yield curve actually shows us that rates look like they might go back down. But in the next 1 to 2 years on the yield curve, rates are, like on Treasuries, are above 4, and then it drips below 4 as you get beyond 2 years all the way out to 30. I'm sorry, that was all technical. Could you interpret what I just said?
So there's the Fed raising rates, and there's also the yield curve. So the yield curve is what the market is pricing interest rates at, right? So these treasuries, they trade. Mm-hmm. So that's where the market's pricing things. Now the Fed funds rate's something different. Now the two things should correlate, meaning they should track. But sometimes the bond market will send signals like, hey, rates aren't going up here right now.
Yeah.
And that's where people are like, well, I heard the Fed's raising rates, but then I looked at the bond yields and I heard this real loud guy from Chicago on CNBC screaming about the bond market. I got no clue.
Yeah.
So long story short, they tie in together, but the bond market is kind of an animal of itself. So I would say your technical analysis is pretty good.
A little bit, but not something where when you look at technical analysis, we don't just not count your personal financial planning. So fundamental investments are number 3 was about reasonable rates of return on your money based on what's right for you, based on the risk you have. Now, if you say, I'm going to make 15, 25% a year, that's unreasonable expectation on any investment that's out there.
Absolutely. And if that's your hurdle to retire, you're not going to win.
Absolutely. So we've been talking about a lot of things, but the idea is this. We save and build our money for retirement so that we have nothing to worry about in our retirement years, where every day is a great day because all you're worrying about is where to drink your morning cup of coffee, or every day seems like a Saturday free of stress. Your retirement income or investments are all taken care of by the team of advisors at Akers Financial Group. If this is the future you want, it's not too late. It's so easy to begin winning in retirement. Meet with one of our team of advisors, a free meeting about you and your retirement. You can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will give you a call on Monday to schedule your free in-person or Zoom meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. What should you be investing in right now? We will talk about that in 2 minutes when Winning in Retirement returns.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
I'm Brian Akers, and here with me today is Alex Monk. We are certified financial planner practitioners from Akers Financial Group, and we welcome you back to Winning in Retirement. Now, financial advisors is people that sit down with you and talk about your situation, and then we implement that through our process, through money management and other styles of investing, and we do full financial planning to make sure we're making the best decisions that fit you and your family for now and into your future. All right, Monkey, welcome. Ready for the second half we got going on here?
Let's do this thing.
All right, so the basic question for the third quarter is, what should you be investing in right now?
Yeah, so to start that, we got to know what do you have? Do you have all cash? Do you have, where are we starting from? Right?
Okay, so where are we starting? So the word where we're starting from means the money's currently housed or located at a certain spot.
Right, it's somewhere, right?
So give me some examples of what that could be.
Okay, so yesterday I had a client come in, in the mid-50s. Her money is all in a target date fund, which the employer just decided that she needed. So that's one place to start. So what we do there is, I pull open that fund and I say, okay, well, how's this thing allocated? Like, do you know how it's allocated? Of course, they had no clue. So I find out that there's like 30, 40, 50% in bonds. So we want to keep the risk level somewhat the same. So we change things up based on where it's at and what plan options are available. Because, under 55, still with the employer, under 59 and a half, excuse me. So the money's got to stay there. So we have XYZ as our options. That's where we started, and that's how we have to make our decisions.
Yeah, when I'm thinking about someone in their 50s and they have the target date fund, one of the things we do in that meeting, we say, well, what are your other choices? And some of the sad parts is the 401ks don't have a lot of other choices, but we could be saying a combination answer. Like one of the fun things that I do is I say, well, we have our core money, the money that's already there, probably should be balanced and a little less risk. But what about the idea of having all your contributions for 2023, if you have time in the market, having all of it go into the stock market, spread out among like 5, 6, 7 allocations, or maybe the whole 9 style box, which I'll explain in a couple minutes. But the idea would be buying the stock market because it is volatile, because it is down. It is a discount rate. What do you think of that thought?
That's exactly what we did. We made some changes.
No way.
Yeah. So, and then some of the changes, we reallocated the balance. Some of the money stayed in stable value, right? So that's our safe money.
Right.
No risk there. I'm okay with that. But our contributions should not be going there. I want to use this volatility as a time to buy. One of the fundamentals is buy low.
Yep. That was number 2.
I mean, and that I think has been going on for a long time.
Well, it just makes reasonable sense. The problem is when is low. Well, if it's lower than it was before, that's low. Is it the lowest? We're not trying to say buy the lowest because you'd have to have a nice crystal ball in that.
So the same client, as we're making these changes, we get to, okay, I explained this is where our new money is going to go. And then she goes, all right, well, I'm contributing 18%. How is that? And I said, well, that's one more than 17.
You did, really?
I did.
Yeah.
And he laughed, she laughed. But that's the thing. Compared to what?
Yeah.
What are we comparing ourselves to? So it's not about comparing yourself to the guy that's next to you, the girl, whoever. It's about your goals and making sure your money is working towards those. That's the only way to compare person to person.
You just slid in our 4th investment fundamental there. I'm not sure if you noticed that you did that, but so far we've had 3 investment fundamentals. The first one was know why you're investing. 2 was buy low. 3 was reasonable risk based on your goals. And the 4th one is make your money work as hard as you do. let's take an examine of this work of the money and let's get it to work or get it to do and work at a steady rate or a faster rate, whatever we need it to do based on your goals.
Right, and improve the rate of return based on the level of risk. So if your risk level wants to stay the same, like cash in a money market earning 0 versus cash in a money market earning 3%, that's a 300% difference.
Absolutely. The thing that I've been getting at recently with clients is what's your expectation on this? Or do you want your money up by next year within 3 months, 6 months? What are you trying to expect? Because the reality that markets in a recessionary time can be very slow to come back broadly. They're going to take time. And so what happens is you have to have a portfolio that's designed with pieces that make money in tough times in large cap, large value stocks, especially the large value area. You have to have that as your fundamental piece. Now they didn't go down as far, so they don't have to come back as far. So the next few years, they'll be saying how great growth side is because they went down so far. So if you're down 33% like last year for NASDAQ, what you might find over the next couple of years is if they get some of that bump back, they're back to where they were. But if you put fresh powder, fresh money into that while it's down, you might be able to make the money back if you give it some time.
Right, and it's strange. Like the further you go back in history and look, your numbers are going to change based on what you're comparing things to.
Absolutely, and that leads to my little chart here that I like to look at. One is like last year, the number one index in category was basically commodities, a broad one, 17% up last year. But the problem is it was never number one the last decade. It was actually the worst performing category for the decade. But because it was up, people are going to flock there and increase allocation, even though that was its big year. Last year's negative was real estate, REITs, publicly traded REITs. Over the last decade, it's been number one back in 2014, 2015. And in 2021, it went up 40%, the publicly traded REITs. And the fact that they went down after they went up that far is not that crazy of a thought.
Right. I mean, that's, people, they see all these returns on their statements. And over the last 10 or so years, they've been double digits for a lot of people.
Absolutely. It's like large cap were 12% the last 10 years, small cap 10.8, mid cap 10.7. Those all brought market returns above 10.
But then the long-term average on the market is a single-digit number.
Yep.
So how do we get there?
Well, the idea is that when you build a portfolio based on your goals, what you're going to accomplish is being happy with the result when you give it time if things reach their averages over time. But the ride, the up and down is what we try to manage. We also got to manage the withdrawals and the need for that money when it has to arrive at its destination, when it needs to reach its goal. You got to make sure you have that money set up for that.
And I meet a lot of people. I met someone else, I think it was 2-3 days ago. They're really good at the accumulation, right?
That's great.
They're good at saving. I can just save, I can save. But now I got all this money. Mm-hmm. I got future tax problems. I don't know how to take it out. How do I withdraw it? How do I avoid big mistakes? It's all these things that they've never done, right? You spend 30 years saving, you're going to get pretty good at it.
Absolutely.
Would you want to try and risk all that by yourself, or would you want to sit down with someone that helps people retire every day?
Yeah. What's your answer?
I mean, I think I'm great, so I think they should meet with someone.
Right, because that extra voice, that extra person listening and understanding what you're doing and helping you tie it all together and hearing if you're so you're married, you have husband and wife, and you're talking about your goals to the future, to bring it all together into one common goal and have someone says, yes, let's do that, and then that person actually make it happen for you. That's a key ingredient of having a financial advisor, is that it's not just talk about it, it actually happens. Many times you hear good topics, good thoughts, you listen to a radio show, and you think, oh yeah, I really should do that. And the reality is you don't do it. But what happens in the beginning of every year, especially in 2023, is that people say, okay, I want to get started. For my first time ever, I'm going to meet with someone. Well, at Akers Financial Group, we have a free meeting where you call us, we sit down and talk with you about your situation. You bring information in, we talk about your exact situation, and then we go your direction. Now, we're not providing some little guide on something or doing a quick calculation for you. What we're doing is talking about what you want to accomplish so that we then can look at everything and bring it all together. That approach takes time, and then we can explain how we would work together to your future.
Yeah, and another person I met with this week, it was kind of a funny conversation. He's like, well, our company provided these seminars where these guys would come in, and then I went to this one and I went to that one, and these things were all free. And what makes you different, Alex? And I was like, well, I give good advice about you.
Yeah, right.
Like, that's the key, right?
Because you sit in that big room and the company sponsored 401k talk, they're talking about with options in the plan, and that they have a little calculator. If you average 12% a year and put this much money in, you'll have this much money in retirement, that kind of stuff.
Yeah, and he made the comment, well, this guy I work with, they're all worried about these numbers that pop up on their dashboard when they log in. I'm like, what does that number even mean? But we tried to figure out what they were using to come up with these numbers on their company 401k site.
Yep.
I couldn't do it.
No. Some 401k sites have a little video, and the video is fun. The video says, if you keep saving at, and then they pause, and then another computer says the number at $20,000 a year, and then you'll achieve this much money, which will give you so much income based on after.
Right. And I'm like, how are they coming up with all this? This is made believe.
Well, it's a fun thing, and what happens it's basically AI trying to drive the information. The hardest part is that personal relationships where you're talking and taking everything into that decision, every goal, desire, dream into that financial plan is a lot different than just picking an investment out of a choice of 10. Now, I know the guy or person or woman, whatever, I'm sorry, I don't know how to say it properly, is bringing donuts to you at work. They talked about the 401k. And they'll have a whole 15 minutes for you, but you probably need a lot more help than that.
Oh, absolutely.
So when you're trying to make your money work hard for you, get a second opinion. That second opinion is where you sit down with someone from like our team of advisors and go over where your money is now, what you need to do. And then as you have transitions in life, changing jobs, changing careers, getting ready to retire, you got to make this plan be workable and be able to turn it on, the plan. So you got to have that plan ready way before then.
And way before then, so that when we go through times like this, when you hear the word recession, we're still there. We still answer the phone. And I'm happy to do so because my plan's working.
Yeah. It's nice when we talk about big losses hard to make up, and then when clients come in, we show how we had less losses because of the design. And that's designed for those getting ready to retire. The higher risk ones, of course, at higher risk in a market down year. And then this year, we got to look at what to buy. We got to stay in if that's the goal for that money. If it's not the goal for that money and you have too much allocated to risk, like a lot of the newer clients, we'll actually dial the risk down. So the key thing is this, is the investment advice is all about you. Because we want, when you get to retirement, we want you to have the best thing about retirement, and that is you get your time back. You decide how to use it. Before retirement, your time is tied up with all other commitments, like mainly your job. A lot of that goes away at your retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at akersfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Investing can be as simple as knowing where your money is and why it's there? We'll try to answer that when we return in 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hey, welcome back to the fourth quarter of Winning in Retirement. I'm Brian Akers. Here with me today is Alex Monk. In case you missed the other 3 quarters, you're here for the wrap-up, for the big information, the final push, and the little bit of a review. You can also go to our website at akersfinancialgroup.com and hear this show on the recording on-air site. Akersfinancialgroup.com provides lots of information and a way for you to contact us to have that free consultation with one of our team of advisors. Go to akersfinancialgroup.com and check us out there. All right. Alex and I were both certified financial planner practitioners. We became CFPs because of the approach. And that's really what we're trying to explain as we talk about winning in retirement. To actually win in that future year, you got to do the right things all along the road to get there. Planning brings it all together, and investing and actually implementing the plan through how you invest your money And reaching those goals will be accomplished by basically following investment fundamentals. And that's what our show today has been about, is 5 investment fundamentals. Number 1 was know why you're investing your money. 2 was buy low. Of course, we'd love to buy at the lowest, but buy low is reasonable, a good idea. The third thing is reasonable risk based on your goals. And we talked about that many times. And number 4 is make your money work as hard as you do. And we're getting ready to start the 4th quarter talking about this. Know where your money is and why is it there. Because investing can be simple if you know why money is and you know where it is and why it's there.
It's called giving it purpose. And I absolutely love that idea. Because when you attach a goal, a thing, a purpose to the money, then you can say, okay, it did this in comparison to what I thought it was going to do. It did this to achieve my goal.
Right.
If not, how do you ever measure up? It just makes no sense in my brain.
Yeah, so if you invest with purpose, so imagine that you have your growth stocks invested for the retirement years in the future. Its goal is to beat inflation over time. Its expectation is to be able to track the stock market. They don't go straight up. It's going to have down years and up years. Could have a couple down years in a row. Could have a couple up years in a row.
Yeah, and typically, we're not going to be able to predict that either. And one of the fundamentals was buy low. If you're all in, you can't do that.
Right.
So, that's the big thing. We don't necessarily have to specify what the low is, but lower than what you paid for some of it could be a start.
Right.
But if you're all in, then you can't achieve that. So, that means balance. You got to have balance so that you can be a buyer when you want to be a buyer. You want to have no scenario where you are forced to do something.
Right. So what happens, though, when you think about investing, you have different things pulling at you, trying to get you to invest for other reasons than your reason. And so what we have to do is understand what noise is out there trying to drive our investment decision versus what is the process of making a great decision for you. Planning does that. Product buying does not buy that or not accomplish that. So when it comes down to investing is know where your money is and why it's there. Imagine that some people that might be insurance agent or an investment broker, they might try to scare you where you have your money into doing all of it into something that has no risk. That also is nowhere near the correct answer.
No, and the fear sale is a huge thing. People have been doing that for years, right? Create this fear, create this need, this urgency, and that plays on the emotions. And that doesn't end up working out usually over a long period of time.
And that's the heart, playing on the heart that the market's down. You don't want to stay down. You want to make sure you don't lose anymore. Sell your stocks that are down 30% and lock it in. And to me, that's not also the right thing to do for all of your money. It's something we have to do within balance. So imagine that wherever your money is, why is it there? And before you do the next thing, why are you going to put that money there? What is the reason that investment fulfills your long-term goals? And make sure it all ties together. Don't ever go with the investment concept of trust me. Never going to be a good idea.
Yeah, and I don't expect, obviously, building a relationship with the clients, you have a level of trust over the years.
Sure.
But even the clients that I've had forever, I'm explaining to them every time we meet.
Yeah.
Why?
Well, sometimes they'll say, oh, Brian, I trust you. You don't have to explain it. And I'm like, I think when you say you trust me, that's even more responsibility on me to make sure you understand what we're doing and that I understand every one of your goals because you're putting extra reliance on what I'm advising. So it actually is a little harder when that person is actually sort of like pushing back and saying, I trust you completely, because that's not really what we would want when it comes to building their plan. We want to make sure there's a give and take, and does this plan fit you? Is it working each and every day? Make sure that it's fitting that goal.
Right, because you want to make sure that it matches the goals, that purpose. Mm-hmm. And so knowing where your money is the perfect place to start. Mm-hmm. If you have 12 different retirement plans that you've been gathering along the year, call me. That's my specialty. I would love to yell at some people in India for you and get that money rolled over and get it wherever it needs to go, or whoever we have to call. I was in a meeting last week, and I think we called 5 different places. It was a death claim.
Right.
And they were in 4 or 5 different countries.
Yeah.
And every process was different.
North Dakota and Colorado, all those places?
All over the place. I think one of them was in like Ireland or something. It's like, you have the best accent I've heard all day.
Right, and that's where they're servicing the money that's there. And what happens is there are products, there's all kinds of things. Everyone's coming with a better idea, the next thing. The hard part is to think the process of how do you make the wisest decision for you. And that's what we're talking about, 5 investment fundamentals. So before you invest money, know what you're getting into, know the why you're getting into. Are you buying reasonably low? Are you investing properly based on reasonable rates of return as a goal, and something where if you take less risk, can you still reach your goal? If you're a great saver, that almost always happens. We have the idea we don't have to take risk on our money. It's like clients that come in and meet us that are 80 years old, it's more about preservation of what they have, and they don't need to double their investment to meet their goals normally.
And it's sometimes you have that meeting with the 80-year-old and they look across the table and they say, well, I'm never going to spend the money I have in the bank, so let's invest this for my kids.
Yes, and then that gives you a new goal and a new perspective of timing.
And that same client may come back when the market goes down and say, well, why are we taking so much risk for someone my age? Like this may have happened. And then I say, well, this is for this time horizon. Oh, that's right. That's why we did this account this way. That makes sense.
Exactly right. The planning has to be applied to you. So I know you've heard that 25 times from me already in this last hour, but the idea is this. When you're looking at your investments, do you know where it is? Do you know what's invested in? And then do you know why it's invested that way? How does it tie into your plan? Make sure we're doing something. Now, talk about someone who's just getting started in investments. They listen to this show about fundamentals investing. They've never done any investing at all. They really need to get started. What fundamental piece, the one piece they should do?
All right. So the first thing I say is, okay, do you have a job?
Yeah, that helps.
That helps. It's a good start. So does your job offer a retirement plan? So that's where I usually start because it's the cheapest thing.
Sure.
Right. The companies that pay the fees, you might even get a match. Like sometimes I can increase someone's salary by 6% just by showing them that they have a match.
Yep.
So that's where I always start. And then if not, well, let's open something. Anything, whether it's $50 a week, $100 a week, build it in the budget, build it in the habit, make it a thing. Right?
Pay yourself first.
Pay yourself first. And then build on it and change your mindset. Like I get a lot of baby boomer clients where I think their pleasure center is around spending, and you can tell by their finances, right?
Sure.
Once you shift your brain to see, get that same type of release or that excitement from generating savings or, seeing your account grow or seeing yourself pay down debt, it generates the same feeling. So it's just switching the mindset.
Encompassing that long-term goal that you've always had. People talk about retirement dreams and they think they can get there in 6 months or a year. It does take time. 20, 30 years is a reasonable career. It's also a reasonable amount of time to grow your assets over time. But you got to start early, save as often as you can. The ones that have been extremely successful that I met with throughout my career have been the ones that tried to save the maximum, and they had it allocated into the stock market throughout the early parts of their career, and they were able to experience those good days, those good decades that have occurred over the last 40 years. Yes, there's been a decade where the S&P was negative for 10 years. That was 2000 to 2010.
You got to bring that up.
Do what?
You have to bring that up.
Well, the idea is it's still a good thing over the years, but everybody talks about how great the S&P 500 is, but they don't think about that one flat down decade. It was up and down. There's some good years in there, but the overall result, if you're in the index the whole year only, you were sort of stuck.
And I think when you said that, you said decade.
Yeah.
Like that's a long period of time that our minds just puts out to lunch.
Well, because one of the top trending trends is to buy all your money in indexes, and 54% of the recent volume in the stock market is index buying. And that's what everybody's been pushed to and thrown to. And that means that those managers are driving the market more than individuals as much. But that the idea of your money, if we start active management, I think is going to be a very great place to be in this volatile market to the future here.
And I think COVID, all the different supply chain stuffs and how it affects different spots in different markets. Like you got some stocks that are positive, some that are down 30%. You know what that tells me? Everything's not moving in the same direction. I should have somebody looking at this.
Absolutely. Now, one of the things like in 22 is that there is the S&P 500, which actually is weighted to the top stocks. So last year, S&P 500 lost like 19.4, but an equally weighted S&P 500, equal amount of money in each stock, actually only lost 11%. And that's because a lot of the losses were geared towards the 5 main stocks that basically had a really hard year last year. They had a great decade, but a hard year.
Yeah. And
FANG stocks.
Like the internet's new. There's going to be these type of things. Yeah. It's like the wild, wild west.
Yeah, absolutely. So the show's been about 5 investment fundamentals. We're glad you listened to this. This is going to help you win in retirement. But that next step to help you win in retirement is to give us a call to talk about your exact situation, because we want you to win in your retirement. So take advantage of this opportunity to begin planning with us at Akers Financial Group. To schedule a free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.